Welcome to another episode of Talking Shop with IG. If you're tuning in for the first time or a seasoned market enthusiast, then you found the perfect pod for you. Ever wondered what it's like to be a fly on the wall of the IG trading floor? Then you're in the right place. We're here to give you the insider view from the premium client desk at IG from our head office in London, and in each episode we will break down complex trading concepts into clear, actionable insights. We explore the latest market trends, look at interesting trading strategies, and offer perspectives from the conversations that we're having with our top clients every single day. Our goal is to make trading approachable, engaging, and hopefully do so with a few laughs along the way. So let's dive in and let's talk some shop. Welcome to Talking Shop. I am joined today, I'm Luke. I'm joined by my normal co-hosts, Pete and Sean. How are we doing?
All good, thanks, Luke. How are you?
Yeah, very good.
Very well, very good.
Thanks for joining us. And we've been joined today, we've had an infiltrator into the group.
That's a nice way to talk about a client, isn't it?
Yeah.
Am I a client today, or am I a friend of the firm, or?
I think we're going to go...
See how this goes.
Yeah.
Yeah. See how good the recommendations are.
Well, you're on payroll, so I think it probably is staff, right?
Fair. Right. Yeah.
For those that don't know, I'm joined by Rich McDonald, a client of ours, long-standing client of ours, and he's joined us recently and is the host of the Trade Live with IG TV show. So we are welcoming him for a special episode at the end of the year, at the end of 2024. And we were trying to come up with something clever to do, because at this time of year, everybody does their look aheads, everybody does their look backs, and we wanted to try and be a little bit different. So because we're traders, we're not banks, we're not trying to do anything, what we thought we could do is critique banks. We can try and go through a couple of different investment banks, try and figure out what they're talking about next year, and let's try and rank them against each other. Let's try and have a conversation about whether they are worth their salt, whether the themes are worth exploring. And that's why Rich has joined us, because of his investment banking background. Before he was a client with us, before he joined us as staff, he was at Credit Suisse. So that is where we're going to start from.
And not just Credit Suisse, but on the buy side as well. And it's the buy side guys that pick apart these research reports and really try and tear them to pieces to find out, as we're doing today, you look across the whole street and see who's nailed it, who aligns with your views, but who can also shape your views.
Yeah, that's exactly right. So I gave the boys homework. So we've each been given an investment bank. I'm repping Team Goldman Sachs.
I'm looking at HSBC.
UBS.
And I'm going against Morgan Stanley.
Morgan Stanley, there we go. So we should hopefully get a good geographical covering. UBS given the European slant, HSBC slightly more kind of international with that Asian slant. So there's, and then we've got the US with JP and Goldman Sachs. But I thought we could start. In fact, sorry, I should probably explain what we're going to talk about. We're going to hopefully rank them for what their calls are on the stock market and indices. We're going to look at commodities and what they think about the commodity structure for next year. And then we're going to see what they say about FX. So indices, commodities, FX is going to be our structure. Why don't we start? We're talking about healthy criticism. Why don't we start with what did they say last year and what are they saying now? So we've got a chart. In fact, Rich, it was a chart you pulled out. We were talking about the Wall Street's average 2024 year-end price for the S&P.
And how they got it wrong.
How they got it so wrong. So where are we just now? We're at what, 60 on the S&P?
Yeah.
So where does your bank rank on last year's call, Pete?
Mine's not even on there.
That's how far off the scale it was.
Yeah. Where's yours?
Mine's mid-table. They went end-of-year prediction 48.50. So some way off, but not the worst.
48.50, that's not the worst. So Goldman Sachs, 5,100. I mean, that's still, 20% off.
Yeah. Mine was at 25.
Morgan Stanley, 4,300.
Ooh, super bearish.
Ooh, super bearish.
Well, and I think that the analyst actually ended up losing his job.
Really?
At some point during 2024, because he was a super bear on the street, and no more.
And what was his general thesis? Why was he calling it down so far?
Well, the general thesis, if we want to reverse back 12 months to now, was that you're going to have issues of a slowdown, of a recession coming, that you couldn't possibly raise interest rates as quick as you did throughout 2022 and 23 without some kind of hit to the consumer. It's been the complete opposite.
Yep.
It's ended up aiding the consumer because we've had markets that have gone crazy. So you're getting the full wealth effect, but also people with savings have ended up benefiting from higher interest rates.
Yeah.
Well, they keep saying that specifically in the UK, if you look at interest rates, I know that the majority of people have mortgages, but those that don't have mortgages, all of these interest rates have been a huge beneficiary to them. So they've actually there's a very big train of thought in the UK. The higher interest rate has actually been inflationary.
That's right. I mean, I doubt Pete's got a mortgage anymore. Around the city.
You've not seen the size of the house I bought? I'm still paying off the West Wing.
Right, let's crack into it then. So we're going to start on stock markets. Right? We're going to start on indices. Who wants to kick us off?
I mean, I think on that, as we sort of just move from that looking back, the UBS note did a similar thing. So they said, right, we're mid-decade. We're going to look at where we were at the beginning of the decade and what's happened. And I think they summarised it quite well. So they said things like global equity markets up around 50%, corporate earnings are up corporate profits up about 70%, US GDP's up like 30%. But in amongst that, you've had all the headwinds, lockdowns, higher rate environment, inflation as high as it's been for decades, and markets have just ignored it. Obviously, geopolitical tension, Middle East, and they refer to it as the Roaring Twenties. So, and their big question was, what is the US election going to do in the immediate term? And are we going to move into it now? Do you want me to go onto the indices and stocks and stuff there?
Well, I'll just add one more thing there, Sean, is how much has the federal debt gone up by? How much have central bank balance sheets gone up by since 2020? So, yeah, wonderful. Earnings have gone up 70%.
Yeah.
But in dollar terms, all that is the fake money that's been created and pumped into the system. So we've got $8 trillion, additional debt on the Federal Reserve balance sheet or central bank balance sheet as a whole. So, all this patting each other on the back, well, you've created a lot of fake money and thrown it out the window at people.
Yeah, but I suppose the point is why, of course, we care in terms of, pending doom if that all blows up, right? But the everyday person on the street doesn't particularly care, right? The reason why we're going to talk about stocks is because everybody in the States, sweeping generalization, everybody in the States is so hell-bent on keeping an eye on their 401k. The S&P is effectively, a barometer for the US consumer strength. If the S&P is up, everybody's happy, they continue spending money. If the S&P comes crashing off, everyone gets really worried. You start to see all the news anchors talking about markets in turmoil and everything like that. So yes, we are seeing a huge amount of debt go up. The question is, does it pass the so what test? Does the everyday person who's now feeling a lot wealthier care? Well, they probably do if it goes belly up. But for now, does it matter too much? As a trader, you're trying to just trade with a trend, and you've got to be continuing to follow that trend. Trying to pick a top is dangerous.
Yeah, and I think there will be a lot of generalisation, a lot of themes throughout all analysts right here. I'm guessing they're all got a preference for US equities. They're all going to be bullish for this year. Certainly after underestimating last year, there's probably almost an overcompensation effect. So, yeah, I think there are, as always, positives, negatives to looking forward. But their base case was generally, it's going to be a positive year, preference for US equities, and a price target. Do you want to get to price targets now? Do you want to
let's do it. Lead with the price target.
I'll start with theirs. So the UBS, their price target on the S&P was, by the end of the year, 2025, is going to be 6,600, so about 25%.
And they missed by 20. They were 25% wrong.
Yeah, this is it. So that's what made me think about the overcompensation effect.
6,600 would be 10%, wouldn't
it? Yes, it would. Yeah.
Even.
I was thinking. Yeah.
Even. Remember, you can get 5% risk-free in the bank.
Yeah.
So they're asking you to take all that risk after 20% up for an additional 5%.
Yeah.
That's interesting. Yeah. No, I mean, looking at you mentioning debt there, and I think, as a trader or people listening to the show who are more kind of intraday, intra-week, looking to make money, looking to do an annual return on the year, that issue of debt is something I think it's perceived by many as being it's a kind of government central bank issue. It's not really the everyday man on the street issue, like you said. Like, they're looking how to make decent percentage gains. And I was looking at the note that I was looking at HSBC, which was talking about China. And that was quite interesting because they are effectively taking a lot of the levels of debt sort of on a local government basis and kicking it into longer term dated government debt. So effectively buying it and kicking the can down the road, which we've seen obviously in the US, we've seen elsewhere, like a big debt transfer program. Like their big issue over there is their real estate sector. They need to sort of steady the ship there. Ever since we had that, that thing with Evergrande kind of luring its head maybe even a year or two ago, and everyone was like, oh my God, this whole China property bubble is going to collapse. And obviously it's kind of barely been talked about, but it's still there, right? And so what they're doing is they're taking the debt, kicking it out 3 or 5 years, buying it through the government and essentially financing with state-run banks. So I think in terms of like where banks see things going, the note that I was looking at, they were saying that maybe this huge boom we've seen in the US since COVID potentially starts to slow down a little bit, and we start seeing bigger growth post-pandemic in areas like China and India. So
long emerging markets.
Yeah, kind of, yeah. And obviously their big headwind or big risk is the strength of the US dollar. So I think on the one hand, you kind of got tax cuts and deregulation and everyone going, we're going to drop rates in the States, versus the likelihood that longer rates stay higher for longer and the impact of the tax cuts causes reduced globalized trading. And then all of a sudden you don't get the growth that you're expecting in the States, but you might get it elsewhere.
Well, you're going to get that as well with Trump, right? The deglobalization. Did you say you found that term friendshoring?
Friendshoring, yeah, about Japan.
Yeah.
Yeah. So friendshoring, I believe it was a term that we're using whereby if a country was effectively producing something which is very useful for the rest of the world, aka chips, then they were kind of effectively friendshored, which was kind of protected against any other sort of like global politics. It's kind of let's just ring fence them.
Is that the TSMC deal being brought on?
That sort of thing, yeah.
So they're still going to be looking to kind of introduce tariffs, but to TSMC, to all these chip manufacturers, they're being brought onshore as a friend because they're contributing to the economy.
Yeah, exactly right. And Japan was another one that they were kind of earmarking for growth over the next year because of that, and because of the way that they've run their economy, and because of their low levels of inflation. But that was tempered with the huge kind of headwind of what happened on August the 5th with the unwind of the carry trade, which sent obviously massive shockwaves through the whole world. So they were sort of saying, if you're going to go into Japan, great, but have some kind of risk modeling hedge on dollar yen or something, which, I assume the big banks probably had on August the 5th, which is why the market bought back within a week, because I think everyone realized that, it was a big tremor, but most were probably kind of set up with some kind of hedge against it. I don't know.
So, and just as you mentioned China there, and you mentioned the property bubble and the potential bazooka that awaits us into the new year, Morgan Stanley have actually focused on that as one of their pillars, because they're saying, forget the bazooka, because high debt levels, overinvestment, an unresolved property bubble, underwhelming domestic consumption, and international trade pressures, i.e. Trump, those have contributed to the structural weakness in China's economy that stimulus package cannot resolve. Lessons from other debt-laden economies suggest the path to stability requires cleaning up the bad debt through write-offs or restructuring by bank recapitalization. So they're talking about some real cleanups on the balance sheets. This approach is undeniably painful, a la Greece back in 2014. But without such drastic measures, then stimulus packages are merely a plaster over the cracks.
But that's always going to be the way, because of the way that politics works. Politics is a 3-4 year gig before you get another chance to be democratically voted in.
Well, not in China.
Or not in China. But it's always going to be this, the point you made, Pete, about, kicking the can down the road.
Yeah.
It's always going to be like that, because, a PM comes in, Rachel Reeves come in as Chancellor. If she doesn't get it right, they're going to get rid of her and they'll just move someone else in. And so there's such a temporary nature to this.
I mean, we have to be careful, otherwise we'll start arguing that, Xi has had the chance to do really positive things, as Erdogan did in Turkey for a long time. You know, some of the transformations that he managed to put through the Turkish economy, they went all wrong in the end because, okay, we went too far. But you've had MBS in Saudi Arabia trying to, we probably don't want to start arguing that democracy and 4-year cycles are a bad thing. But I mean, Merkel's ruined Germany, absolutely destroyed it. Every single problem of Germany now is because of what Merkel did, whether it's the energy policy or the pension or the railways. I mean, try and get a train that's not delayed in Germany now, and you're going to be, waiting a long time.
It's crazy.
It's crazy. So to kind of then add in where Goldman Sachs came in, similar type of price target in terms of the S&P, they're saying 6,500, so even less than UBS. Yeah. So you're right, you're looking at the 4.5% as the rate. We're expecting, the day that we're recording this is FOMC day, so we are expecting a rate cut later this afternoon, this evening. So you're looking at only a 5% premium to take on all that risk. We haven't really mentioned AI yet, so that's been a big theme through all of these notes. What Goldman's have said that they don't actually think we're going to see a ton of growth in terms of the main indices, but they actually think that a lot of the leaders may lag. They don't think they're necessarily going to come off, but the Nvidias, the Teslas, the Apples of this world, this year's been all about concentration. The S&P has never been as concentrated as it has now. As we record this, the last 2 weeks, the S&P has seen more stocks go down daily than go up, yet the S&P index itself is flat. So this concentration effect is getting more and more extreme. Their big play is about that broadening out next year. Their big play is about stock pickers. So what they're saying is all of those profits that have been made in the big AI names, they're going to get reinvested into the other 493 other S&P stocks that haven't got any love. So they're saying it's the year of the active stock picker. They're specifically looking at, they used a term, and it was companies that do not have, they were looking across Europe, and they were specifically saying that we think Europe may do well with companies that don't have a US equivalent. They mentioned healthcare, they mentioned green energy, and they mentioned luxury goods sectors to keep an eye on. They then looked, as you have to, at AI, and we'll come on to that. They broke it down into a couple of different subsections. They called them enablers, so the semiconductors, the equipment providers, and I just use the phrase, things that build the infrastructure. And I think that's the 2-year cycle that we've had. We've had the Nvidias, we've had the Broadcoms of recent history. Those guys that build the infrastructure have been doing really, really well. Then you've got to look at what they're calling hyperscalers. So how do you take all of this data that everybody's using and process it? So what you do with it, so build it, process it, and then use it. So maybe next year you start to see these killer applications. Does a Novo Nordisk, instead of needing to do huge amounts of drug trials through countless costly rounds of human trials, just run it through an AI model, and it takes weeks as opposed to months. So Goldman's very much in the broadening out instead of huge growth. So a year for the stock pickers, and keeping an eye on the AI.
So UBS were almost contrary to that. They explicitly said, and it's not new news, that it's going to be the investment opportunity of the decade. You should have something like 25% of your equity portfolio AI focused. And to your point, they did say
big chunk.
Well, it is a big chunk, right? Normally, what do you go with?
Well,
3-5%,
people usually say in the more kind of wild investments, like crypto up until recently, I suppose people have always said maybe 5-10% of your overall pot. I think wealth managers are now allocating capital in that way, using things like IBIT and stuff, and putting that into people's portfolios.
I think the minimum number that you can have of diversification of different themes or stocks is 7. So 25% in one very highly correlated theme is.
And the AI and robotics that you gave me a few years ago, Lukey.
Still got it.
Yep. I've got it purring away.
I love that. My shares, robotics,
5% up, baby.
Bot. 95% up. You're very welcome there, then.
But I think UBS they think that initial leg isn't over yet. So they were still saying that you should have a lot for now tilt towards that enabling, and then in a couple of years focus on the application level. So they're still thinking there's legs to go in this current phase of it. So it's interesting sort of allocation, quite an aggressive allocation, certainly at this level.
This rounds us off actually quite nicely. So what we're basically saying is most banks are slightly bullish next year.
Yeah.
We think that AI is going to be a big theme. You look at the enablers, you look at the infrastructure, and broadening out with risks and an eye on debt is going to be a big macro.
Well, HSBC actually drilled down into the weeds a little bit more here on the AI and what they call the decarbonisation of the world, which they find that the two go hand in hand. Now, this is quite interesting.
Yeah, you've cut ahead. So this is where I actually think we can start to now talk about commodities.
Got you.
Because we talk about AI, we talk about power.
Yeah.
That seems to be a theme through all of these notes.
Yeah.
I didn't mean to cut you off.
Yeah, no, that's all right. No. So basically, they were kind of saying similar to what you've been saying there about the big names, etc. But realistically, they looked into the transition and urbanization and decarbonisation, all this sort of stuff. Basically, clean energy and all of this sort of stuff requires significant materials. So they were saying wind turbines require concrete, steel, aluminium, rare earth minerals, plastic, etc. Offshore wind farms demand even more steel than coal plants. Now, they were saying with urban populations expected to get to 9 billion by 2050 and materials needed to do those urbanizations of smart cities, high-speed trains, infrastructure, AI power. We've seen Google this year already coming up with the small nuclear reactor looking into that space.
Well, Microsoft bought 9 Mile Island.
And those stocks going crazy on the back of it because they need this power to generate enough to run these things because unfortunately the sustainable energy that we've got at the moment isn't robust enough to be able to support that sort of infrastructure network. And it's kind of a self-fulfilling cycle where you want to use AI more to push that forward, but at the same time you've got to fuel it with traditional power sources, all under the kind of net zero guidelines of let's get there. And it's like coming up with ways to do that. So one of the things they were looking at was it was quite interesting. They were saying that decarbonisation has two categories, which is mitigation and adaptation. So mitigation encompasses clean energy, electrification of your transport, corresponding infrastructure, all that sort of stuff, which demands materials, namely copper. And then they were saying adaptation ties it more into basically how we build stuff and live in communities and stuff using AI and all that sort of stuff. So the two go hand in hand, but realistically both boil down to one material factor or one commodity, which is copper. And so they were like,
it's been awful.
Yeah, and something that you love, you talk about on the show, you're always into, Glencore's, Rio's, Anglo's, and you look at those stocks and you look at the year they've had, apart from Anglo with the, approach from BHP, which is buoying it up. They're all
was primarily for copper.
Yeah, they're all roughly 20% down year to date.
What's the underlying? How's copper itself performed?
Dreadful. It's traded between $410 and $435. And it's currently at 413. So it's right at the bottom of its range. And, Goldman's pumped it this time last year to no avail. There's the eternal bull story that because, for anybody who hasn't looked into copper closely, you have a very small surplus or deficit of demand versus supply. And if it gets knocked out of equilibrium, if you get problems in Chile, or in Australia,
something like that.
Argentina, and Peru, and it knocks, or you get strikes, and it knocks that supply down, then the price can skyrocket because the amount, the size of the market relative to the surplus or deficit is really tiny. So people keep on talking about that supply just. The miners since 2015 haven't invested in new mines. And then in COVID, there was absolutely no need to invest in new mines and new supply. So you've got nothing coming on, but we've got all this demand coming through. So it all makes sense, but the price refuses to go.
Yeah. Goldman's have said exactly the same thing. They've come out and they've basically called investors out for this green kind of decarbonisation piece to say you cannot have one without the other. To get to where we want to get to, you need to have carbon emitting power sources to get us there. You would need to create new mines in order to bring the copper out of the ground. You're going to need to have things like cement producers, steel producers, like you said,
Yeah.
in order for us to get to a space where we can have new nuclear facilities, or you can have huge battery storage solutions, you can't get there without the other. And so there is a theme that most of the banks seem to be talking about, that it feels like the buck is dropping a little bit. You know, all of this money that's been invested into ESG, it's all gone with incredible intent, but you cannot get there without, you know, you've got to ruffle a few feathers, basically. Is the right
Yeah, of course. Yeah. I was looking here, they were saying that they need an estimate of 27 new copper mines are needed by 2030, which is a new one every year in the States. And they've got to produce an estimated demand of 300,000 tons of copper on an annual basis in order to do all the AI and data centers. So it's like, they've got to do all of that, and you've got to do all of that by 2030, but you've got to meet net zero, and you've got to hit 2050 this, and you've got to do this and the other. I mean, they did a nice little diagram here of like what power needs to be provided versus renewables. And it was like the bull case was that 78% of the energy mix needs to be from renewable power in order to get to net zero by 2050. But realistically, all that raw material constraint you're not even going to get anywhere near 50% of that.
Yeah.
That sounds like we need to go shopping for kind of UK AIM-listed copper mines.
Well, lucky you say that. I've got a lot of research on that.
Unfortunately, you are a bit of a disadvantage here, because Goldman's lost their top copper analyst to a hedge fund in July. My good friend Aditi, big shout out to you, Aditi. But yes, she's been on visits to Peru, and she's been down the mines in Chile. And it just shows you that hedge funds are coming in for those copper analysts everywhere, because they know that's the story over the next 2-3 years.
Yeah. UBS, their high conviction pick was copper.
Really?
That was it, yeah.
It makes a lot of sense. It makes a lot of sense.
Shall we go over the ways that you can play it?
Yeah.
Of course, Antofagasta is tough because it's very much held by the family that own it. So you've got potential taxes on, like we do to the oil companies here. Chile do it to their copper mining companies. Then, of course, you've got Glencore. You've got Anglos, and this is exactly why BHP came in to buy Anglos, because it knows that copper is the big story sometime over the next 10 years. But Anglos is still sitting there on some great copper assets. So they just need to get the problems in South Africa out of the way, as they're trying to divest those platinum businesses and iron ore.
Is that your conviction pick then?
Well, I mean, it wasn't coming in here, but now that I've heard it from UBS,
balls in the room,
HSBC, then
would you play it? Would you play it like that? Would you play it via a minor, or would you try and own the underlying? Because the underlying, I suppose, if all of a sudden you get, playing the underlying is going to be really difficult in terms of timing, because whilst you have the demand squeeze that we know that we're going to get, as soon as supply comes online, the price will come back off again. So it's
you're also getting no dividend.
You get no dividend. Yeah.
So you want to get paid to own this stuff, I think.
It will
so
probably take a long time too.
The stuff that HSBC were looking at in the note that I read wasn't specific to the stocks, but it was to that sort of area. But what they called it was looking at value investing. And I sort of did a bit of a deep dive into kind of what value stocks are, or what characterizes value stocks. And basically it's low PE ratios, high dividend yields, the book value, which is their kind of total assets less liabilities divided into the free float, and gives you sort of the net value of the stock. And then you've got whether or not it's an established business. Now, if you look at the types of stocks we're talking about, Glencore, Rios, Anglos, BHP, Antos, I mean, they tick the established business. No worries. Dividend yields, not bad. BHP dividend yield 7.9%. It's pretty attractive. The others are about 2 and a bit. And then you look at where they are year to date, they're all off about 20%, apart from Anglos. So you could build yourself a little basket, get some dividend yield, have some exposure to it.
I think there's a copper miner ETF as well.
That was going to be my next question.
And that includes First Quantum. So First Quantum's a really interesting one, because they had a big a copper mine in Panama. And the government came in and said, no, that's ours now. And that, obviously the stock price down 25%, I think it was. But if, for example, somebody who come in and have negotiations with the new Panamese easy for me to say.
Panamanian?
Panamanian.
Panamanian?
Is it?
I think it's
I
Panamanian.
think it is, yeah.
The Panamanian Devils.
Panamanian. If you could, then First Quantum's worth a look at.
So potentially what we're saying is then look at the big diversified miners, pick up some yield potentially, or look at the ETFs as a way to do it. Nice.
Yeah.
Okay, cool. So that seems to be there's a bit of harmony in the commodity space. So everyone seems to be looking at
Definitely, yeah.
carbonization before decarbonization, copper to play the kind of AI theme demand,
Nuclear.
and nuclear as a way to do it. Nuclear is interesting. Just before we move on, because we know that Microsoft took a chunk and they bought 9 Mile Island. We've got Rolls-Royce. Was it Rolls-Royce?
Rolls-Royce are doing some of those
many nuclear reactors.
More nuclear reactors.
Yeah.
Google took a big slice in it.
Yeah. So there's a big emphasis on nuclear. Again, do you look at uranium though? Because that is a commodity that's in demand.
Could be explosive next year.
Oh, nice. Got to dig deep for that one. No.
Okay. So there's some themes there, right? Let's move on to the final topic.
Well, I would just throw in there Morgan Stanley neutral on oil, because there's just this oversupply, and that's a big theme into next year. I know oil's a big favorite for people to trade.
Yeah.
So, but it does look like there seems to be a consensus that the market's oversupplied into 2025. So any problems that you get, some kind of physical disruption through tensions in the Middle East, then it just, you go into that wall, which looks an incredible trade by Biden, if he knew what he was doing in letting all the strategic reserve go in the mid 80s, high 80s.
Yeah.
A hiatus, and then buy all back. Very, very chilled in buying it back.
UBS were bullish on gold as well, not as much, but they still thought it was going to be higher next year, 2,900. So
yeah, HSBC bullish on gold as well, flat on oil.
Lovely. I've got some short June puts that need to come back in again.
Yeah.
Bought the dip too early. Then I think if we move on to FX, then there's a clear theme around the dollar, but there's interesting different views. So who wants to start us off in terms of what they're thinking about the dollar? Of course, we've got Trump's inauguration early January. Everyone's thinking about what is he going to do in his first 100 days. You've got deglobalization themes. You've got tariffs. You've got everything that comes with it. So go.
Who wants to take it?
Yeah, HSBC, they were kind of flat to small bearish on the US dollar. I think their biggest concern is that it does continue to strengthen, and that ruins all the sort of emerging market plays. But they actually see it probably staying where it is or just coming back slightly with the predicted rate reductions, albeit maybe not as many as what the market was originally pricing in, which could keep it kind of bid where we are. But nothing too crazy there.
Yeah, I think similar from UBS. They think it may be strong in the short term, but over the year they think it's overstretched at current levels. So they thought, again, likelihood of rates being higher for longer was probably overstated. They did touch on inflation there. I think that the potential for inflation to go up again is probably overstated as well. So for that, yeah, they, in general, across most majors, their calls for the end of the year were about 5 or 6% lower for the dollar. So yeah, I think they were probably more bearish but yeah, they were still think it's overstretched.
See, Goldman's were the opposite. Goldman thinks that this dollar strength is going to continue. So they fell short of actually making a call at a price, but they've got an economic activity tracker. And so what they're looking at across the next 12 months, they see they see the US trending above the historical trend line in terms of activity. They think the rate cuts will come, and they think that will stimulate growth. But they think that because there's growth in the US, they think that people will naturally want to continue to buy US equities. So there's going to be a natural demand for US dollar. They actually then see that's so they think that's going to be dollar supportive. So they don't necessarily call for it to be up 5-10%. They're just saying they think it will continue to remain strong. They actually think that what it's going to be kind of trading against is they're really concerned about the euro. They're really concerned about the euro. And I know, Rich, you've spoken about it on the show. I think when they look at this economic activity tracker, they're saying that the euro area, if you get Trump that comes through, we know what he's talking about in terms of his trade policies. He says tariff is a beautiful word, right? That's exactly what you're going to get. Europe has traded recently like that's going to hit them the hardest. The euro's been absolutely trashed in the last month or so since he came in. So they're really worried. They're almost calling for euro dollar to go, down to parity.
I think it was way below parity.
Really?
Yeah, I think it's 90 written all over it.
So UBS called it end of next year, 112.
Wow. That's how you make a market.
Yep.
It's like one of your prices, 90 to 112.
Reassuringly wide.
Sure.
I think the one thing that Goldman's are quite concerned with, so they basically think the dollar's going to continue to stay dominant. They think euro is weak. They're concerned about growth in the UK. They're really concerned about growth in the UK. They're seeing that GDP growth in the UK is going to be 1.2% next year. That's against what the Bank of England is saying. Bank of England is saying 1.5%. So they think the GDP is going to be worth less. They said there's the recent budget that the UK government have put out is less expansionary. They've said that we're going on with the US. They just say that there is uncertainty over there, and they think uncertainty will breed dollar strength, so the pound will lose out as a result. And they're really concerned about, they've called out, which I thought was quite strange when you're looking at sterling, was the planning changes for the housing market. They say that there's going to be such a need to spend to fund the Labour budget, which means you're going to have to borrow more, which means you're going to have to see the pound devalue. But the Labour government have said they're not going to do that, and they're going to go about it fiscally.
Or rates go higher to sustain a stronger pound, which means that house prices come off and maybe you don't need to build as many houses.
Well, they were calling for rates in the UK to be at 3.25% by the end of next year. So market's currently pricing December UK rates at about 4%. But they're really saying they're going to cut maybe sometime in the spring or summer if they need to. But Goldman's were really bearish. They said that, this budget is really going to cost us. They're really going to have to try and stimulate some growth. They're going to try and cut rates.
I don't think the bond market allows it, because if they have to borrow, right, and the budget doesn't math, the math doesn't math, then market is going to dictate interest rates, not the government, and not the Bank of England.
What was their call on cable? Did they have one?
No, so actually the Goldman note in total, apart from that slight call on the S&P, they were very light of calling target prices.
Okay.
What did UBS
They
say?
were 135 on cable.
135 on cable.
By December next year. Yeah.
Your holidays in Scarborough can widespread. So we got a really interesting trade here. Morgan Stanley are saying that the risk of a sharp yen appreciation, right? We all know that the pressures in Japan are completely different, right? Strong economy. So the risk of a sharp appreciation, which has got problems throughout the whole world if that happens, that's been curtailed by the stronger dollar. Right, but what happens if the stronger dollar, if we see some kind of surprise there, suddenly you get a negative non-farm payroll number, or growth disappoints, and we don't have that stronger dollar anymore, then the yen strengthens, right? The carry trade, we have a second explosion there, because there are tens of billions of dollars being repatriated into Japan, and they can buy their own debt rather than buying US debt. So rates across the whole world are going to go higher. So if you have that, that August the 5th might have just been the little teaser.
Yeah.
Yeah.
The little amuse-bouche.
Exactly. Wow. And then we get, the unwind of all this, 23 times earnings on the S&P 500 and, the AI trade and all these things.
So what are you buying? You're buying dollar yen puts, 140s, 130s, 120s, kicking them all out of the calendar? Or are you selling up calls? How are you attacking it?
I put the two ideas together, right? So I'll take the dollar risk out of it, because I actually think that the dollar is relatively okay. And in the meantime, I think that Europe's in a whole world of trouble. Germany and France both impotent. No chance of getting any policy through there until May. Mm. So you've got a weak euro, but you've got a strong yen. So it's long yen against the euro, or short euro yen. That would be my favoured little flurry into the FX
McDonald's 2025 tip of the year.
Not advice.
Not advice to your own research.
Revisit that next year.
Yeah.
Pete, can I get a price on euro yen, please?
Yeah. What's that? You buying euro yen? Okay.
Never get it the right way around.
Does that round us up then? What have HSBC made any calls on
Not really. No, just like I say on the US dollar. Very light on all the other ones. Nothing on cable. Nothing. A little bit on Japan. Again, just like echoing Rich's comments there. Really, that their economy should benefit. They've got quite a high growth target for Japan relative to this year. 0.2% negative. It would be 1.2% positive. But they temper that with all the issues with the currency.
Makes sense.
And the pressures to do something with their rates.
Rich, I've got a question for you then. So that rounds up. So FX, we're kind of all on similar paths apart from differing views on what the dollar's going to do.
Yeah.
Commodities, I think that we've covered that pretty well. We know that we've got this decarbonisation, this power-based argument. Copper's a big, interesting play. And I think on the S&P, we're currently looking at stocks. We think growth, but not that much. More broader.
Value stocks,
sectors, value stocks, dividends. So potentially a kind of a rebalancing of everybody's portfolios. Cool. That makes sense. Thank you so much. My question is, for our listeners, why do banks bother? Why do they do this? Because we've just proved at the top of the show, we called out everybody's S&P price targets. They were all wrong, right? And I think it's fair to say that we can be healthily skeptical of everything that we've just spoken about. But why bother? Do they then, does it help their sell-side analysts?
Before we get to the answer, who was the closest on the predictions? Should we give anyone credit before we sort of rubbish them entirely?
So the S&P as we stand now on the 18th of December is about 60-60.
Yeah.
Okay. I've never heard of the guys that got it closest. Yardini Research?
Yeah, so Eddie Yardini is incredible. If anybody ever wants to get fundamental analysis and charts, then just do a Google search on him, because he produces it all for free, and everything's there for you to see. So that's where I track my S&P earnings. He updates S&P earnings expectations every day.
Yardini.
Wow.
So Yardini Research.
Yep. Yardeni. Ed Yardini.
Ed Yardini. Well, he called the S&P to be 5,400, and that was the closest. Followed closely by one of my favourite analysts, Tom Lee at Fundstrat. He's so bullish.
Who thinks it's going to 7,000 by June.
He is so bullish. He also called 250 for Bitcoin, which is very bullish. So yeah, sorry, to go back to the question. Everyone tends to get it wrong or goes by such a wide margin. Why bother?
It's think of it like a Christmas tree, right? Because that's the time of year that we're in. So you've got to have the head strategy outlook for the year, to then have an equity strategy and a FX and commodities and bonds. And then you go down into, right, what's our favorite sector of the year? Okay, we want to be long miners, short tech. Right, okay, if we're that, then let's drill down into those sectors. What's your 5 top ideas and your 3 underperforms for that sector? And so it all feeds down. The commodities team put in their commodity targets, and the equity guys have to take those commodity targets to do their, equity models, and that spits out. So it's all a well-oiled
machine.
Well-oiled machine.
Well-oiled Christmas
tree. And then of course they sell. The whole point is that they sell that research to the buy side, and funds and hedge funds tear through it, tell them they're completely wrong, but then still pay them anyway. But it helps shape the buy side models. Those are the models that count as the buy side analyst, what their expectations are. But somebody like Andrew Garthwaite at UBS is just incredible, an absolute fountain of knowledge. You sit down with these guys and you just, you walk out of the room and you feel like your whole brain's grown. So Garthwaite, it was good.
It's like being on Trade Live with IG, isn't it?
Yeah, it did when you were on in the morning. Yeah.
Well, to round off our podcasts, we like to play a little game called the Margin Call. So cue music, Brad. Let's go to the Margin Call. So, Rich, for your benefit, hopefully you've listened to the podcast before, but we like to play a game called the Margin Call. So who out of the last fortnight across markets, who is taking the biggest L? Who's the loser? Who's had a bad run? Who needs to stop themselves out? And what we do each week is we try and pick a story each, bring it to the table, and because you're our guest this week, you're going to pick the winner. Okay?
Deal.
Go. Sean.
Sean,
as always,
here's the one.
mine always starts with non-financial related. But this week, there was Ofcom were advertising a job that was for basically monitoring websites for like illegal content, child access, and it was a job that was aimed at sort of monitoring porn websites. But someone at Ofcom retweeted the job posting with, and I'll quote, "Always wanted to work in porn, but don't have the feet or an OnlyFans account. Now is your chance."
Wow.
But it gets worse because I think senior people liked it and stuff like that.
On the official Ofcom.
Yeah, so he basically reposted the job with
Right, with there.
with that strap line.
Yeah.
But obviously, you're trying to protect children from dodgy websites and stuff. And it's obviously got a backlash from charities, and rightly so. But yeah, I think ill-advised was putting it, was understated.
What was the line they led with? Ever fancy a job in porn?
Always wanted to work in porn. I mean,
Unbelievable.
his job title, by the way, was Online Safety Supervision Principal. Manages a team responsible for engagement with online pornography services. And that's how he's trying to get people to...
So they got slammed for it, right?
Maybe, yeah. Maybe a piece of
Sounds like
show
they
was
were
at the Christmas
watching
party
porn.
and they came back and...
And it was Ofcom.
Ofcom, yeah.
Yeah. Very good. Mine's more related to the, I guess, the fashion luxury sector. You could be thinking,
you know a lot about.
Well, exactly. Is it Kering? Is it LVMH? Is it Burberry? And it's actually only today that I noticed that this sort of real issue within that sort of fashion world. And the margin call of the week has to be Rich's trousers. A nice light khaki chino, sort of pulled up to the waist.
I have to.
No belt with the t-shirt tucked in this morning.
Yeah. Sorry, we can't.
Are you allowed to repeat the line that you shouted across the desk?
No, definitely not.
Thank goodness nobody watches to the end of these podcasts. Just write in and if you're still watching.
I don't know how I can follow that. So my one again was fairly recent. Did anyone see the CEO of SoftBank on stage with Trump the other day?
Oh yeah,
No.
Did you see that? Great.
Oh, it was so funny.
Good.
Because they were investing.
Yeah.
Right.
His name is Masayoshi Son. He's the CEO of SoftBank.
Easy for you to say.
Masayoshi Son. And they famously funded the Vision Fund. They famously, funded a load of flops like WeWork, right? So they've done the SoftBank Vision Fund has never been a huge
Punched
success.
25 billion on NASDAQ call options.
They did it.
Yeah.
So they got an appetite for risk.
Yeah.
An appetite for risk. Anyway, so in Trump fashion, they've pledged to invest $100 billion in the US over the next 4 years, right? Great. Trump's on stage, everyone's clapping, this is fantastic. And Trump, he's gone on and as this guy, and he's not the tallest guy, right? But he's a third of the height of Trump, or like half the height of Trump. It looks kind of like he's just about, over the little kind of mic stand, right? And he's saying, look, we're really proud, $100 billion. And Trump just goes, yeah, could do 200 though.
So good.
And the fear on his face, he kind of looks back at Trump and he kind of looks back and he goes, ha ha ha, you're a really good negotiator. Ha, ha, ha. And it was the worst. And Trump slaps this guy on the back and like yanks him around. Like, goes,
That little power hug that he like.
Oh, it was
unbelievable. With the handshake, the 28-second handshake.
Unbelievable power play. I've never seen anything like it. But yeah,
Crazy.
just like $100 billion. Yeah, you could do 200 though. Apparently they only had $30 billion in cash last month. So I don't know where they're getting the money from.
It's all smoke and mirrors, like all good stocks.
But then he sort of ventured into his, you're a great man. You're a great man. I know you'll get it done. Like in front of an audience who's just, put him on the spot, bully him into another 100 billion.
Unbelievable. So yeah,
Crazy.
I don't know if the margin call gets.
Talk about putting people on a spot for me to decide between those three. Well, definitely in last place is Mr. Ward.
Thank you.
So yeah, and whoa, that's really tricky between the two. But I think it's got to be Pow Pow.
It's got to be
Pow Pow takes the win.
Yeah,
and deservedly so.
Thanks. Thank you very much.
Just for
I often
that.
win, by
I
the
don't know
way.
how you managed to Google search
I often
that
win,
one.
by the way, I think.
You do often win. Yeah, I'm slightly concerned what the kind of social media algorithm is pointing that story to you at.
That was on the BBC website.
Sure.
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 I hope we're going to finish up with our own S&P So we can have a look back in 12 months' time and who was the closest.
Go on then.
I think it's only fair, if we're going to bash the other analysts, we should probably put something out there.
Right. Go on then. I am bullish. I'm going to go. I think the risk premium. I think rates will continue to come off. I think the dollar will stay fairly steady. I'm going to go 7-1. I'm big. I'm going big. 7,100.
Well, I was going to go 7,000 to keep a round figure, but I thought I'd be overly bullish there, but no. Nice.
So Sean's saying 7-1.
No, you're 7-1.
I'm sorry, I'm 7-1. You're 7.
Yep.
I'll go just a modest 10%, go 6,600.
Yeah.
4,789.
Woohoo!
Specific.
Ultra bear.
Book in your book.
You've been hanging around Morgan Stanley.
4,789. We are going lower.
And are we going to?
And what do you think? What's the rationale there? What's the big driver? Geopolitical tensions, all-out war, rise of the robots, humanoids taking over.
A realization that literally all we've done for years now is grown the debt pile to an unsustainable level, and the fact that the US budget deficit now is going to be exacerbated by just paying back the interest on that debt. I think inflation continues, so therefore they can't cut interest rates. The debt repayments are high, and therefore the whole thing starts to crumble in the second half.
Those puts must be quite cheap around these levels. Quite a good trade.
Yep.
But
that's 2 trades I've got.
There you go.
I mean, are we going to just summarise what the notes have said?
Yeah, let's
summarise and
just quickly. Let's just summarise what's going on. So, Goldman Sachs, there's going to be a broadening out of the rally. That's basically what they're thinking.
Yeah,
is the easiest way to summarise it.
Yeah, I think position for lower rates, more legs in stocks, certainly in AI. UBS were buyers, obviously strong buyers of copper, gold, and dollar. They think it's overstretched.
HSBC was kind of a small reduction in growth in the States after years of astronomical growth post-COVID, and some boosting in areas like China, India, and also this rotation into more value plays, value stocks, specifically copper-led.
And Morgan Stanley arguing with themselves because they present one of your arguments and one of Sean's arguments in that their first part is how to invest in a fully valued market. So very much pointing towards, well, it's going to be a case now of alpha rather than beta. So a stock picker's market. Mm-hmm. But then their second contributor comes on and says that we're now entering what we believe is the optimism phase of the bull market. And that's one before euphoria. And euphoria is when you get the silliness that leads you to then a crash. I think we're a lot closer than they realize. I think we entered euphoria.
Okay.
With Tesla up 64% in 1 month.
Well, on that bombshell then.
Yeah.
Thank you so much for joining us, Rich. That was an amazing conversation with you. Thanks, guys, for coming. And we just want to say from everybody here at IG, I hope you all have a fantastic Christmas. I hope you have a really prosperous new year. I hope some of that content helped. And we'll see you next year.
Merry Christmas.
Ho, ho, ho.